If you've ever received a Form 1098-T that looks like this, where the scholarships total more than the tuition payments received, you might think that you don't qualify for an education credit. Well, if you have a certain type of scholarship, you might be able to claim an education credit after all. I'm the Tax Geek, and here is how to report scholarships as income. Oversimplified. This video assumes you know how education credits, particularly the American Opportunity Credit, work. If you'd like a refresher, check out the video shown in the card above, which is also linked in the description. In general, eligible expenses that can be used to claim an education credit is the difference between the payments received by the institution and any tax-free scholarship assistance received, as shown on this Form 1098-T. You can add to this any cost for books and equipment when claiming an American Opportunity Credit. Scholarships or other financial assistance to education can be divided into two categories. First, a restricted scholarship is a scholarship that must be used only for the eligible education expenses of tuition, fees, books, and equipment. But scholarships can also be in the form of unrestricted grants, which can be used for both eligible education expenses and additional living expenses, such as room and board or off-campus living arrangements. The most common type of unrestricted grant is the Pell Grant, but there are others. The IRS considers scholarships to be taxable income unless they're used for qualified educational expenses, which almost all of them are. If they are taxable, they are considered to be unearned income to the student who received the scholarship. But with unrestricted grants, a student can elect to designate the scholarship as taxable income and pay tax on it. Why would a student want to do that? Because doing so would free up eligible expenses that can be used to claim an education credit, or increasing one that is already claimed. Let's see exactly how this works, using a couple of examples. Alvin, a 26-year-old single taxpayer with no dependents, decides to go back to school to finish his undergraduate degree. He meets all the requirements for claiming an American Opportunity Credit. Alvin also has W-2 income of $22,700. Alvin's 1098-T shows $12,750 in tuition payments received by the university. The scholarship total of $13,000 shown on the 1098-T includes a restricted university scholarship of $7,000 and an unrestricted Pell Grant of $6,000. At first glance, it might seem that Alvin would not be able to claim an American Opportunity Credit, leaving him with a tax liability of $813. But if he designates $4,000 of his Pell Grant as living expenses and declares it as taxable income, his tax liability increases to $1,223, but now he has enough eligible education expenses to claim a full American Opportunity Credit. He uses the non-refundable portion of the credit to reduce his tax liability to zero and receives the refundable $1,000 credit as a refund. So whereas before he had a tax liability of $813, he now receives a $1,000 refund, putting an additional $1,813 in Alvin's pocket. This can also work with parents who claim the American Opportunity Credit for their dependent children. Let's look at Marianne and Darren, whose son David is a full-time college student. As you can see from this Form 1098-T, David's scholarship, which is in the form of an unrestricted Pell Grant, equals the $8,500 in tuition paid to the university. Marianne and Darren's joint adjusted gross income is $125,000, and they claim the standard deduction. Again, at first glance, it doesn't seem like there are any qualifying educational expenses to generate an education credit for Marianne and Darren, giving them a tax liability of $10,534. But look what happens when we designate $4,000 of the Pell Grant for living expenses, and have David file a tax return and report it as income. Even though the scholarship is, by definition, unearned income, the IRS considers it to be earned income when it comes to calculating David's standard deduction. Since David has no other income, either earned or unearned, his tax return will show a zero liability. Now, $4,000 is freed up and can be used as eligible expenses that Marianne and Darren can use to claim an American Opportunity Credit. Remember from my video on the American Opportunity Credit that whoever claims the exemption claims the credit, regardless of who actually pays the expenses. This gives Marianne and Darren an American Opportunity Credit of $2,500, $1,500 of which reduces Marianne and Darren's tax liability, and $1,000 which is directly refunded to them. And lest you think the IRS frowns on this maneuver, the IRS actually encourages it when it is appropriate, as shown in pages 16 and 17 of Publication 970, Tax Benefits for Education. A link to this publication is given in the video description. Scholarships are reported as taxable income on line 8R of Schedule 1 and ultimately show up on line 8 of Form 1040. Here's David's Form 1040 as an example. Of course, there is the risk that David could have additional earned or unearned income, which might either trigger a regular tax liability or even kiddie tax. It is very important to look at all of a dependent's income to make sure this strategy would work for you. Additional information on this topic, as well as resources, are linked in the video description. If you found this video informative, give the video a like and share it with anyone else who could find it useful. Subscribe to the channel to see more oversimplifications of our overcomplicated tax system. And as always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.